during the presentation here about the fact that it's not just the short-term use of cash. Coming out the back end of this is going to require a bunch of cash as well. So let's get started. This particular KPI is a KPI that everybody is pretty familiar with. It's utilization. It's the measure of how much of our direct labor, so in our case, how much of the engineer's time is actually spent on billable work. It's a very fast changing KPI. If you happen to get timesheets that are presented on a daily basis, you can actually track this KPI at the daily level. Typically, most companies are going to monitor it at least on a weekly basis, maybe monthly. But if you monitor your utilization on a weekly basis, it's a really good predictor of short-term financial position. So you can react. If my utilization is low at the beginning of the month, I can take steps to improve this month's financial position. And it's one of the only metrics or KPIs out there that'll allow you to do that. Now, the downside of the utilization, there is no standard way to measure it. It could be measured in percentage, it could be measured in hours, it could be measured in total hours, average hours per week. It could include only the engineers plus PTO, engineers plus the indirect labor component. And so there just doesn't seem to be a standard way to measure it in this industry. Not too big an issue right now because we're not going to try and benchmark. All we want to know is how are we doing today relative to how we were doing in previous times. So it's really for you important to try and keep an eye on my utilization relative to what it was in the past. Now, I mentioned things are going to change, right? So utilization is going to change, and it's going to change pretty dramatically. We're probably going to see the utilization on a billable perspective drop off. If you currently have a target of 80% billable, you might see that drop off to 70, 40, even down to 40%, which means that then I've got a whole bunch of hours that I'm paying for, hopefully using things like PPP to pay for those hours, that I should actually try and get control over. So one of the things that you should look at in terms of this metric is start really measuring how much time is going into sales and estimating. And even more importantly, how much of that time can be spent on the business or creating best practices, turn into CSIA. How do I implement some of those? How do I prepare even to get CSI certified? It's still one of the fastest moving metrics to measure your financial health. But at this point in time, I would recommend you're looking at it more like an investor. I have the federal government through the PPP program investing hundreds of thousands and maybe even as much as millions of dollars into that unbillable portion of my company. So what am I getting for that? For 8 weeks, I'm going to have a lot of money being poured into on business type stuff. So let's make sure I make the most of it. The next KPI standard, labor multiplier. And what this measures is basically if I have a $10 cost of an hour and I sell it for $30, then I have a labor multiplier of 3. Pretty straightforward measurement of the cost to the selling rate. This one is a little bit more standard in terms of the way it's measured across the industry. 3.0 is a pretty standard target. The nice thing about this is I can measure that at the individual level or at the project level, at the client level, at the company level, at whatever level I want to do. The downside of it is that it's a little bit slower moving than utilization. Typically, we only know that at the end of the month. Once we've done our financial run, then we've got some sense of what the labor multiplier is. The labor multiplier is not likely to change too much on time and material jobs, but on fixed price jobs, it can change dramatically based on one thing, and that is I might have my engineers trying to maintain a certain utilization level, and so they're camping on a job. And I have way more hours on the job than I ever quoted for it or ever expected to. So I could see a downturn in my labor multiplier. So really important to keep an eye on that. We also might actually change our labor multiplier intentionally. So by that, I mean, maybe we have to do some reduced pricing or selling at a lower rate or maybe we even have pay cuts to employees. So there are a couple of intentional changes to the labor multiplier that could happen. If we do find ourselves selling at a lower rate, I strongly recommend that the conversation with the client is pretty clear. This is a temporary thing. This is a COVID-19 initiative. It is not something that we are planning on extending beyond this current pandemic. Another downside of labor multiplier is really that it is slower moving. So it doesn't move. It's probably, of the three so far, it's probably the slowest moving one because it takes into effect how far along you are on a project and percent complete and things of that nature. But that doesn't mean you ignore it. It is critical. It's the thing that keeps your utilization in check. So keep really tight control over it, even though it is a very slow moving metric. Labor backlog, and I'm really talking specifically about labor backlog here. It's how long the company could survive if we didn't get another order, right? So it's how much work that we have on the books, we have orders for, that we have yet to complete. It shouldn't, because we're only looking at the labor backlog, it shouldn't include materials or reimbursable expenses. It shouldn't include all of the work that we've already done on projects. It's only the future work that we have to do. And a lot of companies monitor not just what we have on the books in terms of hard contracts, but also what's called the soft backlog, which is really high probability. We're pretty certain that we're going to get that work. So in the chart here, the white is the hard backlog and the yellow is the soft backlog. So this backlog, it's going to change as well. A couple of things are going to drive the change of the backlog. Obviously, the one is that it may be harder to get work. So we're going to see our backlog drop down. But the other thing to keep an eye on, if you're only tracking backlog at the total revenue and there's a shift in labor or material mix, that's going to impact how much work you actually have. So you really want to break that out. You really want to be looking at the labor backlog, not the aggregated one. A couple other things that happen is we may see a shift from the CapEx to OpEx, where companies are not tackling big capital projects. They're moving into, I just have to keep this plant running, or maybe I've got a little bit of downtime, so let me do a bunch of maintenance. So we're seeing a little bit more of the shorter term projects, which is good because they turn around a little bit quicker, but that would also tend to shrink down the backlog so that we have backlog that is, instead of maybe 6-month backlog, we're seeing 3 or 4 month backlog. The other thing that is definitely happening is, we talked about the soft backlog. Soft backlog is a lot softer now than it ever was. Even your customers are not certain about when they're going to be able to cut that order. And so keep an eye on just how soft my soft backlog is. And probably the biggest issue to watch on your backlog, figure out how you're going to separate out constrained work from unconstrained work. Constrained work is work that you have the order for, you need to do it, you're committed to do it, you got the resources, all of that sort of stuff, but you can't actually do the work. And you can't do the work because maybe you can't get on site, the customer's got the site shut down, you're not classified as essential service, whatever it is, but the customer actually puts the project on hold. And so being able to break your backlog down to identify that is probably going to be the toughest, but one of the most critical things to do. The other thing that it's not a bullet up here, but I think I want to make a point about is there's a tendency, we talked about labor multiplier, possibly dropping our rates a little bit to intentionally get in more work. Be very careful about taking on too much of that. This too will end, and we don't want to be at the end of this downturn with a whole big backlog full of low margin work. So keep an eye on how much of that work you have on the books that is of a lower margin. when we come out the back end of this, I fully expect that we're going to have high demands on automation, on all of the labor that the systems integrators provide. I would much rather be in that mode, selling work and building up my backlog. Cash flow, I don't want to spend a whole lot of time on cash flow. All of these other KPIs ultimately yield cash, right? They ultimately drive to the profitability of the company, which spins off the cash. You're going to see tons of, you've already seen tons of information about protecting your cash. The whole concept of the PPP and most of the federal programs are around how to protect the cash in individual companies. And so a couple of things here that I want to point out. Brian's going to hit on this a little bit more in his presentation. And then again, Michael will spend a bit more on the longer term of it, but stick to your terms. So even if you can get cash in sooner on projects, it's pretty important to do that. You're going to see some customers that are going to want to push some of that stuff out, right? So they want longer terms on payment and things of that nature. And something to consider there is, rather than pushing out the payment that much further, consider payment terms so that they will pay some portion of it over a period of time. And also, now's a good time, if you're not already doing it, get those interest charges on late payments. There's a small percentage of integrators that do it. They do it consistently. They get paid consistently. You know, it's something you should consider, particularly because we're going to see some of this stuff, some of the cash moving out. And then finally on this one, it's really financial management tool, right? It's not the operational side of the company, it's the finance, but operations is the group that impacts this. One of the things that I'm going to make this point here, and Michael's going to stress a little bit more, it's not just maintaining that balance in that tank as we have the image here. So as our inflow drops, we're going to reduce our outflow to keep that balance where we want. As the company tends to shrink, when we get to the back end of this, we're going to need a bunch of cash to finance the growth, way more than what you've been, like say, even 6 months ago in terms of your cash demand. So Michael's going to talk a little bit more about that. I want to move on to the concept of triggers. Triggers are things that you put in place around each of these KPIs. So ways in which I'm going to track the KPI and I'm going to watch it as it makes a change. I'm going to look at, say, 3 different states, a green, yellow, red type of state. There are specific actions I'm going to take when a KPI moves from one state to the next state. So they're defined very specific actions. They're defined by the leadership team now, while everybody's still friends, while you're still talking to each other, while you still have a clear mind. And they're the sort of thing that you want to get in place before the event occurs. Once the event occurs, whatever it is that causes that trigger to trip, it's pretty hard at that point to have good, clear, rational thinking. It's hard. It's more difficult. Let me just put it that way. I'm going to quickly go through a couple of example triggers. I don't want to spend a lot of time on them. These PowerPoint presentations will be included so you can look at them later on. And I want to make sure we get time for Brian and Michael here. But here's an example for cash flow. So green condition, yeah, we got lots of cash. We can support payroll and our AP for 5 months. No major risks on any receivables. Line of credit's intact. And we're going to monitor this on a monthly basis. As we're monitoring it, we notice that, whoa, our line of credit's just bumped up to about 50%, or our utilization has dropped below 45%, or maybe our major receivable is at risk. And now we're going to shift over to, you know what, we're going to monitor it weekly. We're going to communicate that something's changing with the employees. We're going to discuss on a weekly basis how we're going to manage cash, possibly even start thinking about furloughs. I'm not saying that these are the specific actions that you're going to take or even the specific triggers that you're going to take, but this gives you a sample of the sorts of things that I would strongly recommend you put in place for each of these. That's cash flow, backlog, a very similar thing. We got lots of backlog, enough for 6 months. It seems to be on track. And then we notice that, you know what, our labor backlog has just dropped to 3 months, or 30% of our backlog is constrained, or our soft backlog has dropped down to some unacceptable level. And I know exactly when that happens, what I'm going to do. Labor multiplier, typically running at 3 plus or minus 0.5. We monitor it on a monthly basis by client. Everything's good until it's not. And these are the conditions that would be considered it's not. My overall multiplier is down to 2.5. I have a project that's down to 1.9. I need to go in and figure out, okay, what's causing these changes, and is there anything I can do about it? Maybe I have to throw a SWAT team in on specific projects. And then similarly, the big one, utilization. My billable utilization is within 5% of the historical average. Backlog looks strong. Everything's green. But at some point in time, my utilization might change, and it drops below 5% of the historical average for 4 consecutive weeks. I need to take action, and these are the sorts of actions I'm going to take. Again, I want to stress, these are not necessarily the specific actions that you're going to take, but it gives you the layout that you might want to consider to put in place for the triggers for your specific KPIs. Okay, with that, I know I had something like a 15-minute slot. I wanted to make sure I had enough time for Bryan to pick up here. Bryan's going to talk a little bit about cash and short-term cash usage. So Bryan, do you want to take it from there?
Thanks, Don. Yeah, so I think that obviously the rest of the time here is going to be spent talking about cash management, both long-term and short-term. And I think, what we've seen over the last several weeks here, probably the majority of our conversations with clients have been focused on cash, because cash is, probably the most essential resource to navigating this crisis. And kind of as Don alluded to there, you really got to kind of think about it in 2 different time frames, right? You got your short-term cash needs and then your longer-term cash needs. I'm going to focus on the short-term here with talking about a 13-week cash flow analysis, and then Michael will get into the more longer-term with the cash forecast. But when you're thinking about the short-term, you're really focused on, can I pay the bills that are coming due? Do I have enough money for payroll? Do I have enough money to cover my rent and pay my vendors and things like that? And then on the long-term side, you've got to be conscious of these things that, yeah, you may have the cash now to take care of your current obligations and things like that. But now, does that put you in a bad position, 6 months from now? We've had a lot of conversation with clients that, they've got plenty of cash right now. They're not concerned. They're able to make payroll. They can keep operations going. But 6 months from now, when the orders that they should be booking right now, when they start being able to collect on it, that cash isn't going to be there. And, when Don mentioned it earlier that coming out of this, when it does end, and there is opportunity and there are, projects available out there, you don't want to find yourself in a position where you can't, you don't have the cash to pay employees or to purchase the materials you need to start working on jobs. So you got to kind of look at both of these kind of hand in hand. So the main tool that we've been going over with a lot of our clients, and we'll have, if you don't currently have a 13-week cash flow that you're using, we're going to make an example available through CSIA that you'll be able to download and use to perform this kind of analysis. But kind of the beauty of the 13-week cash flow forecast is that it is relatively easy to set up. You'll see with the example that Michael's going to show you in a bit. I feel like the cash forecasting model that iLumin put together has a lot more horsepower behind it. It can do a lot more. You can run different scenarios through it. It really helps you kind of make some decisions for the long term. But the cash flow forecast is quick and easy to set up. There really are just 3 things that you need to get it going. First is your beginning cash balance. What is your balance as of right now of cash on hand? And then you need to be able to estimate your cash inflows. So, those are going to be your receipts, things like that you're bringing in from your customers. And then what are your cash outflows going to be? So, your payroll expenses, utilities, rent, things like that you're going to have to pay out over the next 13 weeks. And most people, if you've gone through the PPP process, you've kind of already been exposed to this a little bit, both in terms of, figuring out what your, what your available loan amount is, or, conversely, what you might be able to get forgiven based on, what you foresee as your expenditures in certain areas over the 8 weeks after you get the loan. So when we're working with clients, trying to get one of these set up, one of the first areas we'll look at is, can you get a cash basis profit and loss? A lot of accounting systems will let you run your profit and loss statement on the, on an accrual basis, or US GAAP basis, or on a cash basis. And so you want to look at the cash basis to kind of see what your expenditures in these different areas have been over the last year. And then you can kind of make adjustments based upon that. If you've staffed up, then obviously your expenditure on wages is going to be higher. Maybe you've moved into a new lease, and so you got to bump up your rent. But so you'll figure out what your estimated expenditures are over the next 13 weeks and drop them into this format. Then you'll want to go through and kind of look at your receivables and payables, and this is where the other kind of C of managing these crises come into play, and that's communication. Don had mentioned before that maybe you've got some customers who won't be able to pay on their normal terms, or will be asking for some additional time to make their payments. So with that in mind, you got to make sure that you're having communications with them, because if you're planning that you're going to get cash coming in from open receivables in weeks 4, 5, and 6, but then your customer ends up having to push out those terms, now your whole forecast kind of falls off. And then similarly, looking at your vendor payments and deciding, are there some of those that you can perhaps delay, or are you going to have to pay those, and then you factor that in here. And this will just really give you a good idea of what's your burn rate's going to be, how is your cash balance going to change over time. If you happen to have like a line of credit or something, that you can incorporate that in to see where you might need to draw against the line of credit to free up some more cash, or where you might, if you have excess cash, you might be able to pay it back to save on the interest charge. So when you're looking at this 13-week cash flow analysis, you're really trying to figure out what you're going to do with that money and how you can manage it. If you have cash, you might be sitting there looking at it and saying, okay, well, I've got money here. I'm going to pay my vendors. I'm going to take care of things. But do you really want to? Is that really how you want to spend that money? If at all possible, can you hang on to that in case other urgent needs come up? I think that one thing that I've talked to some clients about is that maybe they typically take advantage of discounts on their vendor invoices for early payments. Is that really worth it right now? Should you really hang on to those payments? Because if you end up paying that now, you might end up paying interest on drawing on your line of credit later. So really, what is the trade-off between those two? Conversely, if you need cash, I had one client who never took the early payment discount from their customers. They would just wait until the invoices were due and collect the full amount. But is it maybe better to accelerate some of those payments from your customer? It may cost you a few percentage points in a discount, but you have the cash now, and there's no concerns that a month or two down the line, if that customer starts running into cash issues, that you won't get paid. So considering some things like that. Also along the lines of communication, the earlier you can start talking to your lender, if you're starting to see that you might be in a little bit of in a bind, the better off you'll be. You can start talking to them now about, is there a way to modify the terms of your current arrangements, or maybe even take on some additional debt to help you get through this short-term need that you have. And finally, you know, we've seen a lot of different things coming out from the government, different stimulus plans and ways to try and help business owners keep cash. You know, the PPP, or the payroll protection program that Don alluded to. We've had a lot of clients who've taken advantage of that and are trying to get their loans right now. There's also the payroll tax deferral program. There's another, you know, economic injury disaster loan that's available through the SBA. So by looking at this cash flow and having this kind of short-term understanding of where your needs are going to be, it'll help you decide if some of those programs really make sense for you to be able to hang on to some cash now and weather these storms. Now, like I said at the outset of this, you're really going to need to also look at the long-range impact of that. You know, if you take out debt now, or if you do the payroll tax deferral, yes, it's going to help you right now with your cash flow. But then in you know, in March, I think of 2021, when you have to start paying the payroll taxes back, you know, is that going to put you in a pinch when you're trying to grow the business and take advantage of the opportunities that are out there? So it's not really a one-size-fits-all solution. You kind of got to look at it based on how your business is operating and what you're envisioning or seeing in the future. So I guess with that point being made, I will hand it over to Michael now so he can take you through the cash forecast.
All right. Thank you, Bryan. Let me get organized here. So thank you all very much. I want to just talk a little bit about iLumen. We're the vendor behind the Talent Retention Toolbox, the CSIA Pulse, and Easy Stats. And I just would like to encourage everybody. Easy Stats is a free survey that we do every month. And we were already asking questions about the impact on the business for the coronavirus as all the way back in February. So we were looking to see what the impact was. And they're good every month, relevant stats related to what's going on with the whole industry. So I encourage you to participate that. If you're not, then please contact Colin at CSIA and he'll help us get you signed up. iLumen, we work with a bunch of different people, CPA firms, franchise operations and associations, and we're always trying to help people understand what's going on with their business throughout the middle of the year, as opposed to just at the end of the year. So we've already talked about what do I do with my cash during a short term or long term, and we're going to look a little bit farther out, and I'm going to skip over some of these slides because they've already been covered. So we are offering to the CSIA memberships a cash flow projection in which you take your historical numbers and then you project it out over the next 12 months. So it allows you to do some what if planning. Is this slowdown going to last for 2 months, 6 months? Is my major project going to be canceled? And then more importantly, how fast is work going to come back on the other side? So we want to focus on the two questions that I put here, and that is, can I make it through the slow period, some of what Bryan just talked about? And then secondly, will I have resources to grow and take advantage of opportunities that are going to present themselves going forward? Because if you have the cash, you'll be able to jump in and maybe get some business that you wouldn't otherwise be able to do. So we have created a projection model that projects both the balance sheet and the income statement. And the goal of it is to show how much cash am I going to have left over, or what's the balance going to be on my line of credit. So we're taking your cash to zero and drawing up on your line of credit if needed, or showing you what level of cash you'll have, paying down your line of credit and showing your amount of cash. So it's a very straightforward model. The nice thing is it's based on the historical data in the system. So that the historical data that you input. So we're going to be able to work off of what your normal margins, turns, that type of, accounts receivable collection terms, what you have historically done. So, but the other thing we're going to do is we're going to project your balance sheet. And, the balance sheet is that other financial statement. Everybody focuses on the income statement, and we want to look a little bit at the balance sheet. And it's the one that really is going to give you the ability to weather the storm. So in a pretty standard balance sheet, you've got cash, you've got accounts receivable, You've got work in progress, inventory, and then other fixed assets. So this is all of your stuff. And over here is who do you owe? So payables to your suppliers, line of credit to your bank, long-term debt, and then equity through money that has come into the company or earnings that have been generated. So as a company shrinks, it's counterintuitive, but that actually is going to generate some cash because your accounts receivable are going to go down and they're not going to be replaced. Your inventory you're going to sell and get paid for those projects that you've been working on. You'll have to pay some to your suppliers and payables, which is going to decline a little bit, but it's going to look a little bit like this. That is the cash as the, you go over a period of time, your balance sheet is going to contract, and hopefully as it does shrink, if you don't have too many losses, you will end up with more cash than you did at the beginning. But if you have to operate at a loss and have to continue to operate and you have to pay your staff at a loss, you're not going to be able to get all your expenses to zero, at least to zero from a cash standpoint. You may lose a contract that does not come back that you were anticipating. So one thing I want to mention is sometimes on your line of credit, you think, well, I'll just draw up on that. If you've got restrictions on your line of credit, then you may want to talk about understanding what those are. And in our model, you can actually model that out and show what your availability would be. You'll have to add what your rates are, but you could do that. I was a former banker. I used to lend money to commercial businesses, very much like CSIA, for a long time with a bank that later became Bank of America. And banks want to lend money, but they want to finance cash flow timing differences. So we have no problem lending money against your receivables while you wait to collect it, or lend you money for a building while you pay it back over time. They don't really want to finance losses because they view those losses as risks that the owner of the business ought to take and ought to have the capital to finance. So as the losses accumulate, you're going to post losses and you're going to have this retained earnings, that account that nobody does anything with is going to start declining because you're going to be posting losses. And as you pay for things and as you have losses, your cash is going to continue to decline. That's pretty straightforward. But what we really want to talk about is what happens on the other side is as you grow, and that's really what we're doing. Since we've got a 12-month model, we really want you to be able to post out and look at it past the 90-day mark, 6 months down the road. What does it look like once things are coming back up? You're going to have to pay payroll, pay your WIP, pay subcontractors, pay all those people for projects that you've got working on, and that's going to suck up a tremendous amount of cash. And in that case, it's going to take the exact same thing. Your cash is going to get squeezed as your accounts receivable grow, your inventory is going to grow, and your equity might be profitable, but you hadn't gotten paid for it, so you don't have the cash. In that case, you'll be able to maybe slow down some payables. You might be able to stretch them a little bit. See, they've grown some. And you might be able to draw up on your line of credit. For this example, I've kept it constant. But if you've got a borrowing base, you might be able to borrow this and understand what that is. But it's going to be, the main thing is you're going to have cash flying out the door as you try to pay for everything to be able to get that equipment you need, get the people in place, pay for, hopefully pay for travel, pay for the people doing the work. So the main thing that I want to make sure is if you have this you're able to project it out, and if you use your cash in your line of credit to survive, will you have those resources right here when you need to grow, when you come out the other side? And so this is going to allow you to project out and look at your total cash position. Just as Don said, now's the time to have serious conversations about those triggers that he mentioned, and says, okay, when is it time for us to get an equity injection? When is it time for us to get our shareholders to loan maybe some of the money that they've taken it back out so that you have the cash resources to do it? I would go talk to your bank, explain to them what's going on, and present it not from a standpoint of we need the cash to be able to survive, that we want to make sure we have it to grow and make it so that maybe a certain part of your line is tied to, increased receivables and WIP so that you can know that you've got the cash flow. I view it as when this ends, there are going to be some unbelievable opportunities for people to take advantage of. You may have to finish someone else's project. You may have to come in and jump in because they didn't have the cash to survive, and now they can't ramp up to be able to do it. After people stop for a while, they may turn around and say, hey, if you can get this done fast, we'll give you an early completion bonus if you can get it done so we can get our plan open, we can get things running now that we've stepped still. You may be able to, somebody else needs cash, what Don and Bryan both mentioned. You might be able to settle one of your payables for less money if you have the cash to be able to pay it. So, but the main thing is cash. That is the main driver of all businesses. It is what is going to make is the only thing that matters in their long-term survival is, do I have the cash, or at least access to cash through a line of credit or through equity to be able to do that. So there are going to be opportunities, and we want to make sure that you can plan those out and look at the projections to be able to do it. So the projection model works very clear. Simply, you insert, you are actually going to key in 12 months worth of data into our system. It's a very straightforward form. You could get any bookkeeper would be able to easily key the data in. And then we're going to be able to work directly off of those items, so we can project out, taking into account if we're looking at your historical data, and you work with a certain industry and they close down everything at certain months, that seasonality will already be built into your historical data, so we will be projecting off of that. If you had one big project last year that is not coming back because of that was just the way that project worked, then that'll be in there and you can appropriately do that. You can adjust your revenue growth. There's multiple ways to do it, month by month, this month versus the same month last year, this month versus the prior month. So if you want to show a declining trend, you can do that. But then we're also going to give you ways to adjust all of the different issues that Bryan and Don talked about. What happens if I ramp back up? How many days WIP am I going to ramp back up to, or how much dollar amount am I going to have? What are my receivables going to end up turning? I used to get paid on average in about 30 days. Now that's going to go to 60. How much cash is that going to cost me? So you can very quickly play with these levers and then look at the trend, and you can play with them 1 month and not the next month, so that you can project that out. We also have the ability to do, put in new debt. So if that payroll, the PPP, payroll performance or protection program works, if you get that cash, then you can put that in there, or the other things that Bryan mentioned, you can have those in there. And the goal, as it says, is just to show the cash or the surplus. And again, you can add the borrowing base to your bottom to the model if you want. And the nice thing is that you can simply, if a month goes by and you have another year's of profits, you can simply go key those into our system, run the whole model again, and it will automatically roll everything forward 1 more month. So you can stay, you can continue to use the model. It's not a one-time thing. As the calendar goes on, it'll start to project and take into account where you are. To get started, it's very simple. You're going to send an email to support@ilumen.com, and we'll get an account set up. We're actually going to, if you're already a Pulse member, we're actually going to set up a mirror company that's very straightforward, and all that will be designed specifically for this, so it won't mess up any of your Pulse or any of your other data. And then we'll actually schedule a call to walk you through the process of loading the data and model it. Our team is used to doing that. We work with companies all the time to help get them onboarded to our system. It's a very simple process, but it's easy to do. But we want to be there to help if you need help. And then lastly, just want to point out that iLumen will be the only one that will see your data. We're not going to try to benchmark this data. This is just a tool that we're offering. We have been a longtime partner with CSIA, and we would just want that partnership to continue. So no one at CSIA will have access to your data. So it's not like you're putting the data into something that the statistics committee or anybody else could see. I have added an appendix to this program that walks you through some of the steps and how actually you would use it and what it would look like. And that'll be available through after this as a downloadable item, but I'm not going to go through that right there. I believe at this point, Colin, we're going to open it up for questions. Is that correct?
Yes, that is correct. So I see one jumped in the Q&A.
It says the one I'm looking at is, what is the cost of the iLumen program? Right now, we are offering this for free, mainly because you're going to end up doing the data entry, and then you'll be able to immediately run the program so that it is there's not, other than us getting you set up and kind of showing you something that's unfamiliar to you, it's a free service. Maybe I jumped in there too early, Colin. That was the only question I saw. So,
No, you're good. That's what I saw as well.
Hey, thanks, Joe.
Let's see. Do you see that one from Jim? We got a question. After things turn around and perhaps cash is low, are banks less willing to lend money based on PO received or same?
This is Michael, and I'll just speak from my experience of being a past banker. And they're going to want to stick with the winners. And if you're truly just financing the cash flow timing difference, and that's pretty common in your industry, then I think they will lend you money to try to get this going again. They realize that this wasn't anything anybody did to cause this. And if you've got a long-term relationship and it paid your bills, then they're going to work with their existing customers. I think this would be a very difficult time to change relationships and move to a different bank. So it might be time for you to pay for lunch for the bank instead of them paying for the lunch.
All right, we'll get a couple more if they come in.
Yeah, while we're waiting on those, Michael, I just wanted to add a great presentation, by the way. It's a concept that is sometimes difficult to get your hands around, gee, I feel good with cash and stuff like that. But being able to see how that cash is going to get consumed on the balance sheet, not on the P&L, but on the balance sheet. Yeah, I think you did a great job on that. And it's one that's often missed. So good job there.
Well, that lesson was taught to me hard by a customer of mine that was in the printing business, and they accepted every deal they could get with no, very thin margins. And they basically just grew themselves out of cash because they had tons of business in there running, but they couldn't keep up with their payables, and their margins were so thin that cash just didn't generate fast enough. And some suppliers finally said no. And then that was the end of them, because once they couldn't get paper in a printing business, they were gone. So
yeah,
if they would have just grown a little slower, they would have been fine because they did great work.
Yeah, and there's a bunch of examples in the integrator community. An integrator that was doing really, really well, good projects, the odd project that went sideways and stuff like that, growing, adding offices and stuff like that. And they really weren't looking at how much it was going to cost to finance that balance sheet, ended up losing the company. So, there's examples out there, and it's amazing how those tough lessons stick with you.
Yeah. And I would say that the lessons are hard, but the opportunities will be there. You'll have the opportunity to bid on a job that you may not have been able to. You might get called in for a contract that you weren't, you can work with somebody that you normally would work with. There's a lot of opportunities to work together, and two companies are stronger than one type of thing. So I would look for those opportunities instead of saying, oh, this is all going to be bad. I think in the long run, it'll be better for the industry, because there'll be a little more sanity around bidding and sanity around things, because you'll have to make a little money on them to be able to survive.
Yeah, I think if you take a look at the industry in the past, our customers, the manufacturers, were always looking at their supply chain and wondering, okay, where's this component going to come from, and where's that component going to come from, and that was pretty front and center, and they'd be worried about downturns in the economy, the supply chain impact. Now what they're realizing is, hey, there's another component to the supply chain that we hadn't really thought about before, and that is the people. And so going forward, there's going to be a lot of the manufacturers are going to say, hey, how do I protect against that supply chain of not having people? The answer to that is automation. So I think at the back end of this, yeah, we're probably in a pretty good spot.
Yes,
Yep.
I totally agree.
All right. Any more questions, anybody?
I think one of the things I noticed, Colin, is we had the people on the line here. There were a lot of people that were international players, and so when we kept using PPP, and just maybe not thinking everybody's explaining knows what it is. So I appreciate Bryan and Michael taking time to okay, that is a U.S. payroll protection program that's in place, and most other federal governments are realizing that that's probably the most efficient way to handle unemployment. Keep them employed, cut one check to the business, let the business worry about spreading that out amongst the employees.
Mhm.
All right. Maybe a couple minutes here.
We had a quiet bunch today.
Hey, Michael, just going back to the forecasting tool that iLumen is making available. Can you maybe touch on, because I think one of the real strengths of that is the ability to run through, some of those different scenarios, right? Like, I expect my orders to be, half of what they typically are, or what happens if they, how does the tool manage that? Do you have to run kind of like one version of each scenario you want to do, or can you input them in and compare them all at the same time?
Yeah, let me, I'm going to just open it up here. And so are you looking at my screen?
Yep.
So it's just based in Excel. So it loads, pulls your historical data in, and then it projects the data out. So you could go file, save as, and run, multiple versions of this and do different projections in different scenarios. Here, you're going to be able to, like I said, select which option you want to use to be able to do that. And the model is going to quickly show you kind of what's going on. So this would be your monthly revenue. This would be last year versus this year. So as you play with this and play with how you want the growth rate to work, then it'll project out kind of each one of the metrics. So you get some feedback of what's really accurate. And then the same thing's through with, the different metrics: gross margin, selling expenses, what your payroll is going to be. And then as you continue to work your way down, I'm trying not to scroll too fast. So we're going to calculate what your normal accounts receivable was. And then, you can say, okay, well, if I project it out, what is it going to be? So you'll be able to control month by month what my receivables are going to do, and be able to show that. And do the same thing with inventory. In this case, it's inventory and work in progress combined. But you'll be able to say, okay, we normally turn it at this rate, or how many days I have, and then you can calculate it and you get the cash balance of those. And then you quickly can see the graphs of each one of the items. So you can see, oh, that trend doesn't look correct. Your gross margin doesn't look correct, or whatever it is.
That's great.
The nice thing it does is, from a planning standpoint, it's going to take your historical data, and then since we're already partway through the year, it's going to project how you're going to finish the year. So for some people, that's kind of what is my year going to look like. So it's going to take how many days of, I think this one is, we have data through February. So it's going to take 2 months of this year and then 8 months of the projected year to show you. Some people might want to look at it in an annual basis so you can see what it's going to look like and how bad. Is that realistic for what I think it's going to be? And then on the projections, you have an income statement, then you have a balance sheet, and then you have a direct cash flow here for each one of those that shows the cash going out, similar to your cash 13-week cash projections model that you've got here. And then all the calculations of your metrics are there. And here's what I was talking about. If you wanted to do a borrowing base, you know, if I could type and spell at the same time, you could type in your borrowing base. If you had, you know, 75% of receivables and X% of inventory, you could calculate that and see whether you're in violation of it.
Michael, I took a look at this tool when you introduced it to us a couple of weeks ago, and pretty straightforward in terms of being able to enter the data. I think that integrators shouldn't have any problems being able to put that stuff in there. And like you said, it's not rocket science. It's just somebody sitting there keying that information in.
Yeah, and it's at a very high level. It's meant to be just how much cash am I going to need? It's not meant to go down to the level of what my utilization is going to be. You're going to have to make that step, but it's all of everything Don talked about is how you're going to manage it on a day in and day out basis or week by week. And this is more of a planning. When do I need to think about having some of those serious conversations? If this scenario takes place in July, okay, that's bad. If it takes place in December, that's not as bad, that type of thing. Just helps you project it out and see what your cash position is.
Yeah, and Don, I think one other thing too that you know, and I know that this offer went out, you know, several months back, but for the participants on the call who are also participate in the Pulse survey, I know that Exotech and Clayton McCurvey, you know, have offered, you know, if they've got questions about interpreting the results, you know, understanding the results, you know, kind of a quick 15-30-minute phone call to kind of talk through the questions they may have, you know, which especially now in trying to compare results to, or interpreting those results in light of what we're seeing now. I guess people, the Pulse participants who are on the phone, just to remember that option is out there to reach out to ourselves, and we'll try and, you know, help answer any questions we can.
Yeah, exactly.
All right. So I don't see many more questions coming in.
Colin, there was one question just came in. Somebody joined late, wanting to know, was the webinar recorded? Is it going to be posted on CSIA? And I think to extend beyond that, the presentations and stuff like that, how do people get a hold of it?
Yeah, so I will be putting that on, it will be hosted by YouTube, and I will post a link to the webinar archive page on the controlsys.org homepage. So that will be right there. And I'll send out a link, I believe tomorrow it'll come out. So that'll go out to all the attendees, and we'll have that link for you.
How about the presentations? How do you want to get those to the people?
As in the slides?
Yeah.
It's up to you guys. I don't have the presentation slides. If Brian, Michael, Don, if you wanted to share them, I can make them available.
Yeah,
Sure.
We'll put them in that Google Drive folder.
Okay.
Yep.
Or if
Alright.
anybody wants to reach out to us direct, we can send them off too.
Okay. So again, just to reiterate, we wanted to start this Wednesday webinar series just to have a place for the community to come together and give some trusted advice to the CSIA members. If you go to the ControlSys webpage on the calendar, we actually have a lot of webinars that are already listed. So if you can make your way to the calendar, you can pick and choose which ones you may be interested in. And our goal with this is to help the community manage, survive, and hopefully thrive with this current situation that we're in. So on behalf of CSIA, I would like to thank Michael, Brian, and Don for this informative discussion. And I'd like to thank all of those attending. When you close out of the webinar, a link is going to pop up for a brief eval. We would appreciate it if you can fill that eval out. And again, we'd like to remind you that a recording of that webinar is going to be available in a couple of days. And to please visit the CSIA website to view this recording or a past webinar you may have missed. So with that, that concludes our program for today. Once again, thank you for joining us, and have a good day, everybody.
Thanks, everybody. Thanks, Colin.
Thank you.
Thank you.
Thank you so much.
Yep.
All right.